In today's video, we will be breaking down Microsoft's $60 billion stock buyback, Intel's custom chip for Amazon, US economic growth, and coffee price surge for arabica beans. Microsoft has announced a new $60 billion stock buyback program, which is one of the largest repurchase plans the company has ever undertaken. A stock buyback, also known as a share repurchase, is when a company buys back its own shares from the marketplace. This action reduces the number of outstanding shares, which can increase the value of remaining shares and improve financial metrics like earnings per share, EPS. For example, imagine a pizza cut into 10 slices. If the pizza shop buys back 2 slices, the remaining 8 slices become more valuable because there are fewer slices available. Microsoft is also raising its quarterly dividend by 10%. A dividend is a payment made by a corporation to its shareholders, usually as a distribution of profits. Increasing the dividend is a way to reward shareholders and can make the stock more attractive to investors. Microsoft has benefited from the rush to artificial intelligence technologies, integrating AI from its partner OpenAI into its products. This includes enhancements in tools like Teams, Word, and Outlook, making them more efficient and appealing to users. What is the market implication of this? This buyback and dividend increases signal confidence in the company's financial health and future prospects. It can attract more investors, potentially driving up the stock price. The integration of AI also positions Microsoft as a leader in tech innovation, which can further boost investor confidence. Next, what is Intel's deal with Amazon's AWS? Intel shares are seeing a positive reaction after securing a deal to produce custom chips for Amazon's AWS division. This deal is significant because it provides Intel with a steady stream of work for its new plants, which are currently under construction. Think of a bakery that lands a contract to supply bread to a large supermarket chain. This contract ensures the bakery has consistent work and income, allowing it to expand and improve its operations. Despite this win, Intel has faced a tough year with a 58% drop in its share price, suspension of its dividend, and significant cost-cutting measures including 15,000 job cuts and $10 billion in savings. What is the market implication? Well, this deal with AWS is a positive step for Intel, indicating potential recovery and growth. It shows that Intel is still a key player in the tech industry, capable of securing major contracts. However, the broader challenges highlight the volatility and competitive nature of the semiconductor market. So what about US economic growth versus rate cuts? Morgan Stanley's Mike Wilson emphasizes that US economic growth will be more crucial than interest rate cuts in sustaining the stock market rally. Interest rate cuts by the Federal Reserve can stimulate economic activity by making borrowing cheaper, but if the underlying economy is weak, the benefits may be limited. It's like lowering the price of a gym membership. It might attract more members, but if the gym's equipment is outdated and the facilities are poor, people might still not join. Weakening labor data can lead to a risk-off tone in the markets, meaning investors might become more cautious and sell off riskier assets. This can happen regardless of whether the Fed cuts rates by 25 or 50 basis points. Citigroup notes that the economic platforms of both Trump and Kamala Harris could negatively impact U.S. equities, with Harris's plans to raise corporate taxes being particularly concerning for investors. The focus on economic growth over rate cuts suggests that investors should pay close attention to economic indicators like employment rates and GDP growth. Political developments and policy proposals will also play a significant role in shaping market sentiment. Finally, why are coffee prices rising? The price of premium arabica coffee beans has surged to the highest level in 13 years due to persistent supply disruptions. Futures contracts for these beans have increased by about 40% this year. Arabica coffee beans have become scarce due to supply issues. The price of those popular beans will increase because more people are competing to buy the limited supply. The disruptions are caused by factors such as adverse weather conditions in major coffee-producing regions like Brazil, which has experienced droughts. Additionally, there are logistical challenges like port congestion and container shortages. Higher coffee prices can contribute to overall inflation, as coffee is a widely consumed commodity. This can affect consumers directly, making their daily cup of coffee more expensive. For businesses, especially coffee shops and retailers, increased costs may need to be passed on to customers, potentially affecting sales and profitability. I hope that these explanations have provided you with a comprehensive understanding of each topic, using everyday examples to illustrate the concepts and discussing their broader market implications. Thanks for watching.